Hello, my audit friends. Let's wrap up the engagement, shall we? Let's now talk about completing the audit, the snapshot version. Now, completing the audit is generally referred to as wrapping up an audit engagement, but this is also traditionally discussed prior to audit reports because we do need to do these things prior to giving the audit opinion or dating the audit report. And these are the considerations to be made under completing the audit. We talk about contingencies and commitments, we talk about subsequent events, we talk about going concern assumptions, we talk about related party transactions, and the management representation letter. Now, all of these, I have to tell you, are the responsibility of management. The auditor only steps in to evaluate the decisions made by management, right? Including as well other procedures deemed necessary, such as, for example, your final analytical procedures. Now, in terms of contingencies and commitments, we might need to cross over just a little bit to financial accounting and reporting, where we get to see the definitions of provisions, contingencies, and commitments. Now, I know this is something that you have already covered in intermediate accounting or financial accounting and reporting. Now, when we go to the audit side, we will, of course, have to consider the presence of these things. As it is very common, one of the common assertions violated for provisions, contingencies, and commitments is the assertion of completeness. So, in order to determine whether these have been completely recognized when needed to be recognized, the auditor performs the following procedures. First is letter I would refer to inquiry with management and TCWG. I have to tell you that for this entire wrap up session, I mean, this entire snapshot session for wrapping up the engagement, inquiry is a very favorite procedure. We get to see a lot of inquiry, okay? We get to see a lot of mention of the word inquiry and the procedure inquiry here. So, inquiry with management and TCWG, read the permanent file because we expect the contracts, okay, and other items of long term significance to be found in the permanent file. And you might be able to see contracts there regards commitments, for example. Another would be to read the client's correspondence and communication files to determine as well if there are no correspondences relating to, for example, subpoenas or litigations that the client is currently facing. Another would be review the minutes of meetings. Now, we know the minutes of meetings is a very rich source of information, especially information which may or may not be found in the books, and then send confirmation letters to the legal counsel. Now, at this point, let us be reminded that whatever reply we get from the legal counsel simply serves to corroborate the information that we are able to get from our primary source, and our primary source is always management. The auditor will also test the professional fees account. Sometimes the auditor might notice an intense spike in the professional fees account, and this may be an indication that the client might have gotten additional services of a lawyer, okay, in the case, for example, of litigations. Another would be to test the reasonableness of the accounting estimates. While we cannot vouch for the accuracy of the estimates, we'd always test as to whether they are reasonable. Review the current file. So a while back we said read the permanent file. Now we are reviewing the current file and the results of other procedures, which might also give you evidence on contingencies and litigations and commitments. And of course, to read news items related to the company. Okay, so that's about contingencies and commitments. Now let's talk about subsequent events. Now, according to our auditing standards, subsequent events are defined as events occurring between the date of the financial statements and the date of the auditor's report. So, assuming, for example, the FS is dated December 31, 2023, the auditor's report is dated April 10, 2024. So, the date between December 31, 2023 and April 10, 2024, so that's subsequent events, and the facts that become known after the date of the auditor's report, facts that become known after April 10 in this illustration. Now, notice the change in the tenor, in the way that it is being communicated to us. Now, this is intentional because if you remember, we said the date of the auditor's report is very important as it fixes your responsibility to obtain sufficient and appropriate evidence. Therefore, for the first half of this definition, events that occurred from FS date to auditor's report date, then the auditor has an active responsibility to obtain sufficient and appropriate evidence. But after the date of the auditor's report, Supposedly, the date of the auditor's report fixes that responsibility. So after the date of the auditor's report, we are no longer responsible to actively obtain sufficient and appropriate evidence. Rather, in the case of this definition, if you can picture it out, we kind of just like wait if facts become known to us. Okay? So we don't anymore obtain sufficient and appropriate evidence, but we simply wait if facts become known to us after the date of the auditor's report. Now, there are two types of subsequent events. There is what we call a type 1 subsequent event, or that which is called an adjusting event, or that requiring adjustment, and a type 2 subsequent event, which is a non adjusting event, which is one that would require disclosure. Now, the main difference between the two is the answer to the question, when did the condition exist? Because if the condition that gave rise to the subsequent event existed on or before balance sheet date, then that will be a type 1 subsequent event. Think, for example, of a customer that was declared bankrupt on April 5, 2024. In our illustration, again, the balance sheet date is December 31, 2023. So, meaning to say, the declaration of bankruptcy of this major customer is a subsequent event. Now, whether it will be treated as a type 1 or type 2 event will be answered once we take a look at the circumstances of the case. Supposing the client told us that during the year under audit, which ended December 31, 2023, the client has already been suffering financial deterioration, has already defaulted on a couple of payments, and has already, showed some symptoms of financial distress. And eventually, the final verdict of the bankruptcy only happened on April 5. But since the condition already existed on or before balance sheet date, then that will be considered as a type 1 subsequent event. Take that same example. We're still talking about a major customer who was declared bankrupt on April 5. But then when we investigated, we found out that all throughout the year under audit, the customer was financially healthy. No problems with the payment, has been a well-paying customer, was able to, avail of prompt payment discounts and such. But then perhaps after the balance sheet date must have suffered some tremendous financial loss that eventually led to the bankruptcy. So notice that the financial health of the major customer was still okay within the period under audit. So in that case, it will be a type 2 subsequent event, whereby the client will simply have to disclose the fact. Unlike the first illustration we had, the client really has to adjust the balance, write off the balance as of balance sheet date. It would be as if the declaration of bankruptcy happened on balance sheet date, because anyway, the financial distress was already imminent within the year under audit. The second illustration, however, because this customer was still financially healthy all throughout the period of the audit, the client will only need to disclose the eventual declaration of bankruptcy of this customer. Okay, now if these subsequent events happened between the balance sheet date and the date of the auditor's report, mean to say this is still covered by the auditor's responsibility, right? The auditor still had to actively obtain sufficient and appropriate evidence. Now, what if these subsequent events happened after the audit report date? So we're supposed to be no longer obtaining sufficient appropriate evidence because we have dated our report, but then facts become known to us, okay, that there is such a subsequent event. It happened after the audit report date, but then before the financial statements are issued. So since the financial statements and the audit report are still within the custody of the auditor, then the auditor can still make, okay, or can still take necessary actions considering the effect on the FS if management does not make the necessary amendments. Meaning to say, it would still be relatively easy for you to change your audit opinion or to modify your audit opinion because the financial statements are still with you, right? You have not yet given it to the client. So in that case, you can still change or modify your opinion. Now, what if these subsequent events, you found out about these subsequent events, or these subsequent events happened after the date of the audit report? Okay, but then facts became known to you, and then also after the FS has already been given to the client. So imagine if the audit report date is April 10, the subsequent event happened on April 13, but then on April 11, you already gave the client the FS and the audit report. Okay, so meaning to say it will be difficult for you now to retract or modify your opinion considering that you have already released it to the client. So if that is the case, then promptly alert management and TCWG not to issue the financial statements and the audit report. Okay, so you tell them, do not issue, keep it with you. Okay, but then the worst possible thing that could happen is if management and TCWG would tell you, oh, we have already filed it with the BIR, we have already filed it with the SEC, for example. In that case, inform management that they should be taking steps to ensure that no further reliance will be placed on the audit report and the financial statements. So we give management the responsibility to prevent further reliance, perhaps to call upon the BIR or the SEC or the parties they have released it to, okay, to prevent further reliance from the FS and the audit report. Now, a bigger problem will arise if management will refuse to take such actions, right? What if management tell you, "Well, that's no longer my problem," right? So in that case, if management refuses to take said action, then it will now be the auditor who will take further steps to prevent further reliance with the advice, of course, of legal counsel. Okay, so that is what will happen across the timeline that we have. So between balance sheet date and the auditor's report date, we're still okay because we're still gathering evidence. After the auditor's report date, but before the issuance of the FS, we're still kind of okay because it would still be quite easy for us to change the opinion or modify the opinion should the client refuse to amend. But then after the release of the audit report, ask management to prevent further reliance. If management does not take said action, it will be the auditor who will have to take action to prevent further reliance. But this will be a little bit complicated already, so we do need to consult with our legal counsel. So back to subsequent events. Now, in terms of dating the report, the auditor actually has the option to either use single dating or dual dating. So to single date means that the audit report will now carry the date of the subsequent event. So in our example, if the original date is April 10 and the subsequent event is April 13, so in single dating, the auditor will date the report as April 13. This will effectively extend their responsibility to obtain sufficient and appropriate evidence to April 13, right? Because the April 10 will, if you can just imagine it, we have erased April 10 and then changed it to April 13. So the responsibility is now extended all the way through April 13. That is single dating. However, another option for the auditor is to consider dual dating. Dual dating would mean that you retain the original date. So in this case, the original date is April 10. And then, so for example, the date would be like April 10, except for note 5, which is dated April 13. So under dual dating, the responsibility will be limited to April 10 and April 13. So it kind of lessens the risk on the side of the auditor. But then again, it will be the auditor's call whether to use single dating or dual dating. So in terms of subsequent events, these are the usual procedures. I told you inquiry is very popular in terms of this segment of the audit. So inquiry with management and TCWG, review management procedures to identify subsequent events because at the end of the day, it is management who is responsible for identifying the subsequent events. Read the latest available interim FS and reports. It might show you some instances or transactions that would give rise or alert you to possible subsequent events. Review the minutes of meetings and again, the inquiry from the lawyers. Similar to what we said a while back, whatever replies we get from the lawyers are considered to be corroborating information intended to corroborate the primary source of information that we have, which is still management. Now let's talk about going concern. Now we know that management is the one responsible to make the specific assessment of the entity's ability to continue as a going concern. The auditor's responsibility is to consider the appropriateness of the use of going concern. Now, if going concern or if the entity is a going concern, there's a reasonable assurance that the entity is a going concern, then we have no problem. We can give the unmodified opinion. However, if the entity is a going concern, it is appropriate to use the going concern, but there is a substantial doubt, and the substantial doubt is properly accounted for and disclosed, then we will give an unmodified opinion with an MURGC. So if you remember the material uncertainty relating to going concern, so this is when we will use it. Remember again, if going going concern assumption is appropriate and there is a substantial doubt, but the substantial doubt is not properly is and the substantial doubt is properly accounted for and disclosed. Okay, now you might get to ask, what if the going concern assumption is appropriate? There is a substantial doubt, but the substantial doubt is not appropriately accounted for and disclosed. Okay, so if it is not appropriately accounted for and disclosed, then it will be viewed as a violation or a misstatement. And so, therefore, the auditor will choose between qualified or adverse opinion. Okay, now what if going concern is inappropriate? But then management has acknowledged that they are no longer a going concern and they prepared it using an other appropriate basis. So in that case, then it's okay, right? Because management has acknowledged GC is not appropriate, but we used another authoritative basis. So that would be fine. That would be still unmodified with emphasis of matter paragraph. However, in this instance, what if going concern is not appropriate and they have insisted on using going concern? They did not prepare it using another appropriate basis because they are in denial, even when going concern is no longer appropriate. So in this case, the auditor will give an adverse opinion. Okay. Now, what if, a final what if management refuses to make the assessment? So, management refuses to make the going concern assessment. So, if management does not make a going concern assessment, then the auditor will not be able to evaluate the appropriateness of the going concern assessment, which management did not make in the first place, right? So, in that case, the auditor will give a disclaimer of opinion. All right, so let's now talk about related party transactions. Again, it is management's responsibility to identify and disclose related parties and its transactions. It is also management's responsibility to implement adequate accounting and internal control systems to ensure the proper identification and accounting and disclosure of these related parties. The auditor, on the other hand, the responsibility of the auditor, on the other hand, is to obtain a level of knowledge of the entity's business and industry that will enable the identification of the events, transactions, and practices that may have a material effect on the financial statement. So in this case, we're kind of like singing the same tune, whereby management is the one responsible and we are there to evaluate, right? So in this case, then we are also reminded that in terms of the level of knowledge relating to related parties, management is expected to have a higher level of knowledge since they're really the ones who are involved in the day-to-day operations of the business, right? So the auditor is only expected to have that level of knowledge, okay, that will enable them to spot or identify events and transactions relating to related parties if such is the case. So here are the steps or procedures rather that the auditor may take in relation to related parties. Of course, identify related parties and related party transactions. This will normally start by asking management to provide us with a list of these related parties and related party transactions. Check whether substance is reflected in the FS. Well, one of our main concerns for related party transactions is always substance over form. So check whether they have been reflected in the FS. Review disclosures on related party and related party transactions. We are mindful, of course, that there are disclosure requirements for this in our accounting standards, and so we need to check if the disclosure requirements are indeed made. Okay, we also have to be alert for transactions which may appear unusual because these unusual transactions can actually be red flags as to possible related party transactions, such as, for example, those which have abnormal terms of trade, or those which lack an apparent logical business reason. If a school suddenly purchases helicopters, right? So that might be because they purchase it from a related party who is in dire need of revenues, or transactions in which substance differs from form. Transactions which are processed in an unusual manner, those which are given special treatments. Have you noticed those which are given special treatments are normally related parties or special parties? High volume or significant transactions with certain customers or suppliers as compared with others, and unrecorded transactions such as the receipt or provision of management services at no charge at all. Or if you talk about, for example, loans loans which have abnormally low interest rates or with no definite repayment terms, right? So those are usually indicators of related party transactions. Now, we are not saying the related party transactions are bad. Okay, so it's very common and usual for businesses to have related party transactions. However, we are concerned with its substance and we are concerned with whether the disclosure requirements have been followed. All right. Now we talk about management representation letter. Of course, it's a representation letter from management addressed to the auditor. Okay. Or it could also be a letter from the auditor outlining the auditor's understanding of management's representations duly acknowledged and confirmed by management. Or it could also come in the form of relevant minutes of meetings of the BODs or a signed copy of the FS. However, the first option, which is a representation letter from management to the auditor, is the one that is required by our regulatory bodies, particularly here in the Philippines, in the case of our Securities and Exchange Commission. So the first option is the more popular option. So here are the basic elements of a representation letter. It's addressed to the auditor, ordinarily dated the same date as the auditor's report, and it is signed by members of management who have primary responsibility for the entity and the FS. That's why we usually see the CEO and the CFO as signatories to the management representation letter. All right. Now, this replet or this representation letter is intended to ask management to put into writing the representations and claims that they have made throughout the audit so they can be a source of evidence. They are part of our evidential matter, but however, they are not a substitute for the performance of audit procedures. So, for example, you can't say, I will no longer do a cash count. Anyway, management has already acknowledged the completeness and existence of cash. So you can't say that. They are simply there to corroborate. Management representations are there to corroborate. They do not serve as a substitute for the actual performance of audit procedures. Now, there are also two types of representations. There is what we call a general representation and a specific representation. So, general representations would refer to representations about the premise of the audit. The premise of the audit being that it is management who's responsible for the presentation and preparation of the FS, they're responsible for internal controls, they're responsible for going concern, and that they will not limit or restrict the scope of the audit. So the general representation is covering the premise of the audit. Now, in case management refuses to furnish that general representation, it is equivalent to a scope limitation. So, ordinarily, the auditor will give a disclaimer of opinion because can you imagine management refusing to acknowledge their responsibility? So, this will be deemed by the auditor as a scope limitation. However, there is also what we call a specific written representation. Specific written representation would cover specific assertions, specific accounts, specific transactions, specific events. So, in cases whereby management refuses to give you this, then it could be viewed as either a source of a qualification of an opinion, meaning qualified opinion, or disclaimer of opinion. All right, so that will be for management representation letter. Now, let's talk about the other procedures deemed necessary, such as, for example, the performance of final analytical procedures to check the reasonableness of the financial statements using now the adjusted balances. Are there still unusual relationships that are being observed? Okay, and this might, if indeed there are, then this might signal to the auditor that there might still be a need to perform additional procedures. Then the review of the working papers and drawing conclusions of results of audit procedures performed, reminding us again that the work of a less experienced member of the team should be reviewed by a more experienced member of the team. Obtaining approval of the client regarding disclosures and any adjustments made to the FS, mindful that what we can only give are proposed adjustments. Okay, we cannot force the booking of these adjustments. It will be management who needs to give the approval so that the appropriate adjusting entries can be made and entered into the books. Overall evaluation of the FS presentation, including the use of the correct line items, the disclosure requirements, and the presentation of the complete set of financial statements. Review other information or documents that contain the audited FS and ascertain their consistency. So, if you would remember in our snapshot in audit reports, or if you haven't viewed that yet, then I invite you to view that. Our responsibility is to read the other information. And of course, communicate with management and TCWG regarding the scope of the audit and other matters of interest to the client. When in our snapshot for audit reports, if you haven't viewed that yet, then one of the things that we actually communicate to TCWG is the scope, no, of our audit. Okay, so we also communicate that one with them. All right, so that's about it. We have wrapped up the audit. So if you haven't viewed our snapshot on audit reports just yet, this may be the perfect time for you to go on ahead to that video and take a look at the snapshot for audit reports. So thank you so much for joining me in this snapshot. Always a pleasure to have these conversations with you. Bye, y'all.